everybody can see the screen. So today we continue from last week discussions on Islamic banking, and what we are going to do is to continue the discussion on the products, the lending products. Anybody who has any questions on so far what we have done? Okay, so we continue. I will summarize in case for your benefit. I will briefly summarize what we have covered so far. We have at last week's session we have defined what Islamic banking is. We defined it as Islamic banks as Islamic financial intermediaries which operate within the principles of Sharia. Then we define what are financial intermediaries, how they operate, and what are these principles of Sharia that we talked about. And in essence, what we said is in order to create financial intermediary operation, Islamic banks use contracts other than loan contracts to create the equivalent impact. So instead of looking at a loan contract, that is loans based on interest, Islamic banks look at alternative contracts such as partnership contracts, sale contract, lease contract, and similar contracts to create similar operation to that of a conventional bank. But the underlying implication is that the operation will be different from the conventional bank's operation because underlying contracts are linked to transactions such as partnership transactions. And that stems from the essential philosophy in Islamic banking, which tries to integrate financial sector with that of real sector, meaning there should be some connection between the financial aspect of transaction and the real transaction. So that's in a sense what we discussed in detail, how this transaction is established, and we did a question on musharaka, which is a type of partnership which Islamic banks get into, and then they provide funds using Islamic bank musharaka transaction. So any questions from anybody on what we did? So what I also mentioned is that the questions we do often will be a basis for us to look at possible exam question will be something similar. You will get one question, possibly with the choice. It's not a compulsory question. You have a choice. In case you want to choose to do, the question will be one of the questions we do with some adjustments. So any questions you all have, please feel free to clarify. I'll be more than happy to clarify any questions you have. So we move on. These are some of the terminologies which we have done already. You can take a screenshot of this if you want to. Riba means interest. Salam means a forward sale. Haram means not permissible. We have covered this in the previous slides. These terminologies are put in brackets, so you can refer to them. Number 4, gharar is uncertainty. Uncertainty. Number 4, musawama is type of sale. So here in this negotiated sale A, musharaka is partnership, but that's the last thing we did. By muajjal is deferred sale. Number 7 is deferred sale. Takaful is insurance. Sharia is Islamic law or principles. Halal is permissible. So these are some of the terminologies. This won't be tested in your exam. Just good to know. right? So again, let me just quickly run through it. Riba means interest. One means I, connect I to 1. Salam means forward sale. 2 to D. 3, haram means not, haram means prohibited. 3 means F. Garar means uncertainty. O is E. Musawama is negotiated sale. A. Musharaka is partnership. J. Bimutual is deferred sale. C. Takaful number 8 is insurance. G. Sharia is Islamic law. H. Halal is permissible. B. So that's just the terminology which is commonly used. So with that, we move into another type of facility offered by Islamic finance, Islamic banks, but we are not going to discuss this in detail. This is an extension of what we have discussed previously, where we have said previously that Islamic banks offer facilities on profit and loss sharing basis, and that profit and loss sharing basis, the main facility that we looked at was Musharaka, which is a partnership, which is a type of partnership. The different type of partnership offered by Islamic banks is also called Mudaraba, which is not a common partnership, which is a contract used by Islamic banks to generally to accept deposits, not to give facilities. Generally, to accept deposit they use, and the principle is that similar to what we have discussed in Musharaka. This is also a partnership, but this is a partnership where between capital and entrepreneurship, capital and work, capital and expertise. So in the previous discussion, we talked about partnership as both the bank and the customer channeling in funds, putting funds together, infusing funds together to create a transaction or a project or at an organization level. But here, that Musharaka is a slightly different type of partnership, where we bring in capital from one partner and expertise from another partner and tie together. So it's another type of partnership. So the principle is only given by one partner, whereas the other partner only gives expertise or his work. And the underlying rationale is that in any economy, you have people who have funds, who have wealth, but are not very keen to undertake work. And you will have a segment of society which is keen to take work, but don't have the necessary capital to do that particular work, make use of that work expertise in a productive manner. By linking both, you could create a productive enterprise in an economic sense. So that's the underlying rationale for this type of product. But again, the same principles which apply to the partnership, that is Musharaka, which we talked about, applies here also. So if we specify the key features, capital is contributed by one partner, so he is called capital provider or Rabbul Mal, and then the other partner only contributes expertise. He's called the fund manager or entrepreneur or whatever the name is used. And then in terms of profits, again, similar to Musharaka, both the profits are based on profit sharing ratio or PSR, which is pre-agreed at the start of the Mudaraba. So profits are agreed at the start of the Mudaraba and pre-agreed. So pre-agreed based on PSR profits. Losses, again, we saw in the previous session, losses is only based on capital contribution. So here also it's the same principle, losses based on capital contribution. So that means since only one partner contributes capital, it is 100% taken by the partner who contributes capital. So the entrepreneur who provides expertise, who works for the partnership, does not share any losses. And then in terms of tenor, it can be for whatever tenor agreed, and the management is completely by the partner who provides expertise, and the partner who provides capital does not get involved in the management of partnership. So if we look at those 5 areas, you may have noted down when we discussed Musharaka, almost similar 5 broad parameters we looked at in terms of capital, profits, losses, management of Musharaka, management of the partnership, and dissolution. There are differences in capital because here only one partner contributes capital. There is no difference in profit sharing ratio. In loss sharing ratio, again, there is a difference because stemming from the fact that only one partner contributed capital, only one partner shares the losses, that is the capital provider. And then in terms of management, again, there is a difference in the sense in normal Musharaka, both partners can participate in management, whereas in general, banks will not participate in management of the Musharaka. Similarly, here, bank does not participate in the management, only the customer participates in management. And then tenor is same. You can decide on any tenor that is agreed by both parties. So there are minor differences, but it has lots of implication. What is the implication? Since only bank is contributing capital towards this Musharaka, it's extremely risky. So we discussed that Musharaka is a risky product. The previous standard partnership is a risky product. We discussed how to manage those risks. But here, it is even more riskier than standard Musharaka. So if you are sitting in credit and you get a proposal from a CRM for a Mudaraba transaction, your eyes should pop out. You should be very carefully reviewing this because on one principle only. Any questions? Because on one principle only, the principle is that entire risks is borne by the capital provider, in this case, the bank. So that is extremely risky, and standard credit view on this would be to discuss with the CRM and see whether this can be converted into a Musharaka. Because a product where bank contributes, so it's equivalent of looking at a DE of 100% debt to equity in a normal company where the 100% debt is given, something similar. So that will, irrespective of actual capital structure, the organization, for the identified project, this partnership means a DE of 100%. So you wouldn't want to do that in general terms. There could be exceptions. I'm not talking about that. But in case you are sitting in a credit division and a CRM brings in a proposal, you should very carefully look at this for a mudaraba funding, because what is meant by mudaraba is that bank takes the entirety of risk associated with the project. Of course, there may be some exceptional way where you want to look at it. That is a completely different discussion. But as somebody who is aware of what Islamic banking is, you should be very careful when either proposing or reviewing a state product, a facility for a customer where mudaraba is proposed, because bank will have high risk in the underlying transaction. Meaning, if there is a loss in the transaction, bank takes entirety of losses, unless the customer can be proved as doing something negligent or in violation of the terms of the agreements, which is again not an easy case unless customer is purposely doing something like that. So from a credit point of view, if you have a proposal like this, it's always good to convert into a musharaka, which allows more easier, more what shall I say, more shared risk rather than the bank taking 100% of the risk. But where the Islamic banks use this product, use this contract, is that Islamic banks use this contract to accept deposits on the liability side, not on the asset side mostly. So where the depositors are the capital providers and the bank is the one who provides expertise. So that is a different structure where bank will accept deposits on profit and loss sharing basis, but we are not going to go into details here. We will look at the advanced side for this discussion. So we are not going to do a question under mudaraba, because we have done a question on musharaka, which is also partnership. But you should know the definition of mudaraba and how it differs from a musharaka. If you understand that those 2 points, of course, that is good enough for us to move on. All right. So your familiarity with musharaka will help you to understand this product. So I explained on five let's say characteristics, 5 parameters, how musharaka and mudaraba differs. In musharaka, that is the standard partnership, capital is contributed by both partners. In mudaraba, only one partner contributes capital, the other partner contributes expertise or works for mudaraba. And in terms of profits, both are similar. Profits are shared based on a pre-agreed profit sharing ratio or PSR. Both are similar. When it comes to losses, in musharaka, losses are shared based on capital contribution. Since both partners contribute capital, both partners share losses. In mudaraba, capital losses are shared by the partner who contributes capital. And then management, again, there is no major difference, managed by the customer. But in musharaka, standard partnership, bank has the right to manage, but bank doesn't get involved. Whereas here, bank does not have any right to manage the partnership also. And then in terms of dissolution or completion, there is no difference. Both can be agreed based on whatever tenor or project both parties agree to. So those are the broad differences between a musharaka and mudaraba. So we are not going to go into details. We are just continuing from the previous discussion on partnership and identifying another possible partnership that we can talk about. And there is another extension. If we have time, we will talk about it. It's called diminishing musharaka. If we have time, we will try to talk about it. But with that, we can conclude our discussion on partnership as a tool to understand, to provide facilities to customers. So that's the first part we have concluded. Any questions so far on that? Anything you want to clarify? Okay, let's move on. So after finishing, once we move on to sale-based contracts. So in order to understand that, let's focus on the sale for a moment. Stop sharing. To understand the contract, let me clarify. In Islamic finance, sale is, can you all see the board? There are three types of sale. Right? Three types of sale based on two parameters: delivery of goods and payment of price. Payment of price. So there are three types of sales. I hope everybody can see the board. Can you all see the board? Can somebody unmute and tell?
Yes, we can see.
Right. Okay. Thanks. So there are three types of sale in Islamic banking that we talk about. One is a spot sale, one is a deferred sale or credit sale, one is a forward sale. And these three areas are, these three sales are categorized by two features. What are the two features? Delivery of goods and payment of price. What do I mean by delivery of goods? Delivery of goods means that, let's say I want to sell this pen. I deliver this pen is called delivery of price. And I deliver this pen to Mr. A and he pays me 100 rupees. The payment of 100 rupees is payment of price. So if the delivery of goods and the payment of price happens now, it's called a spot sale. Of course, it's not very theoretical, very simple thing. If you get the goods on one side, you have to make the payment. So if the goods are delivered now and the payment is paid now, it's called a spot sale. And goods are delivered now and the payment comes later, it's called a deferred sale. And if you make the payment now and goods are delivered later, for instance, it's like a pre-booking, which is common now. If a new phone is being released, you pay now to get the phone in 1 month's time or something like that. Or if there is a new TV you want to buy, you pay now, it will be delivered in 1 month's time or something like that. So that is the forward sale. Apartments is a good example, but we'll come to that in a minute. So those are the three type of sales recognized in Islamic finance: a spot sale, a deferred sale, and a forward sale. And if you all are familiar with, if you are paying attention, you will question there is one area missing. We have got now, later, now. One combination is missing, later. Now that is the conventional forward. Conventional forward is that both the payment of price, and the delivery of goods happen later, which is not acceptable from a Islamic finance point of view, because when both happens later, our definition of uncertainty comes in Islamic finance. So that is not acceptable from an Islamic finance point of view. So conventional forwards, where we promise to transact in future, where currently neither delivery of goods or payment of price happens immediately, is not acceptable in Islamic finance. All right. So now looking at these three types of sale, what can you come to conclusion? First thing is, one feature that we can conclude is that price of this pen is 100 rupees, let's say. Price of this pen is 100 rupees. On spot basis, invariably, if I sell this on credit, it will be 120 rupees. It will be more than the spot price. It can be 110, 120, 105, 130, whatever. It will be more than the spot price. And when I sell on forward, it can be lower than the spot price. It will be 90 or 80 or whatever the price is, but lower than the spot price. That is how, of course, this is not something new. This is the normal way the markets work. And all traders know you can make money by buying on spot and selling on deferred, buying on spot and selling on deferred, buying on forward and selling on spot, or buying on forward and selling on deferred. So you can make money by changing the type of sale based on the delivery of goods and payment of price. There is same goods, we can make money out of them. So that is known to traders throughout centuries, because different types of sale will command different types of price. And if that can be made use of course, that can be used as an alternative to create a equivalent of a loan contract. Now that's what we are trying to do here. So buying on spot, on selling on deferred, we are trying to create an equivalent of loan contract where the payment of price can be later. So there is a time element brought in. Or buying on forward and selling on spot, we are trying to create a equivalent of a loan contract where delivery of goods happens later and price is paid now. So using the sale contract, we could create an alternative contract that can be used to offer financial intermediation, financial accommodation. So that's what we are trying to do in this particular transaction. So this case, we are going to look at a type of forward sale, which can be used forward, a combination of spot and forward sale, which can be used to give facilities for customers by Islamic banks. So the type of sale we are going to look at is called Salam. is called Salam. The deferred sale we are talking about is called Murabaha, but we will come to that as we move on. Is the structure clear to you all? Any questions you want to ask on the structure? Right. Okay. So we'll move on to the slides. So now we are talking about Salam. Salam is a type of forward sale. So again, the question comes, why is this, what is the rationale? What is the rationale to offer a forward sale? First of all, the rationale, of course, we'll discuss as we move on. The rationale is, of course, to facilitate economic activity, and Salam in its original use has been used for agriculture, right? Agricultural sector. So it is the reason for that is that when a farmer goes in for agriculture, right, goes into farm, he has a major uncertainty. What is the uncertainty? After his hard work, after he plows the land, after he buys and plants the seeds or plants the trees, how long does it take to get the results, get the harvest? And once the harvest is received, what price will it fetch in the market? So there is lots of uncertainty for him, because for him to rationally invest his money by choosing the right product or right time, whether to invest or not invest, he doesn't have all the information required for him to make that decision. So that's why he takes a guess. He does not have much choices, so he goes and he plants what he can plant or what he has planted in the past, or based on some looking at the market prices, and today the prices are high, so let me plant this. By the time he plants, by the time the harvest comes, by the time he goes to the market, sometimes there is an extra additional supply and the prices dip. Number two, there could be some uncertainty, there could things be different, he doesn't get the necessary harvest, he can get into trouble. So Salam is a contract which, in a sense, looks at people like this, people who are producing goods, and starts by giving a forward price today. In a structure of sale, we saw the price is paid today for a delivery of goods in future. Delivery of goods in future. So today we give the farmer his price for him to deliver goods for us in future. So let's say in 3 months' time. So if a farmer can produce 1,000 kilograms of whatever we let's say paddy, so we agree on a price today, and we give him that price today, so that in 3 months' time he delivers us the goods that we agreed, right? 3,000 kilograms of paddy. So what it does is, before he starts the farming process, he is given a confirmation on the price. I will buy this price, I will buy this harvest at a given price. So the price guarantee is given to start with. That minimizes the risk of the farmer. That takes the risk away from the farmer. Not completely, to some extent. It gives him some kind of a price indication. This is what your price will be when you finish your harvest and come to the market. So that is seen as beneficial from Islamic finance point of view, because that segment of society takes a risk which they are not capable of mitigating fully. Because that's why you will see a rich banker going in a big car, you will see a rich engineer going in a big car, but chances are you won't see a rich farmer going in a luxury car, because that segment of society has been taking risks which they are not they are neither qualified nor have the expertise to manage, to take risks. The risk, how to manage the commodity price risk. Of course, in very advanced market, commodity price risks are managed by experts in quantitative finance. In very advanced markets, very advanced commodity markets, using very sophisticated instruments. But our farmers are exposed to this risk and invariably get hurt by this risk going against them at times. So the original thinking behind the Salam, the rationale behind the Salam, is to give these farmers some kind of a forward price, some kind of agreement on forward price, so that their risk that they are taking to some extent are mitigated. And there are ways for whoever is giving this price, in this case the Islamic bank, to manage that risk by what are called, by entering into parallel transaction, which are called parallel Salam. Of course, we won't go into all the details, but we will try to understand how a Salam works. As forward sale, how does it work, and how do banks manage that process? All right. So that's what we are trying to identify here. Any questions so far? So one important aspect I started by, it's very important to understand the sales structure for us to understand this better. That's why I drew the sales structure: the spot sale, the deferred sale, forward sale. And what we are trying to do is to buy on forward and sell on spot, in the process make money, and also in the process give the necessary timeline for farmer to for the customer to pay back the bank the bank's capital and the necessary profits. Right? That's the whole idea in this. So it's very important. Salam is a type of forward sale, or Salam is the type of forward sale used by Islamic banks.
Excuse me, sir.
Yeah.
So under this Salam product, so those credit facilities are granted only to farmers, is it?
Mainly to farmers, but it is in some variation of this is used for other industries also. Mainly to farmers this is used, but other variations include, for instance, for construction industry, there is a variation of this product that is being offered. It is also offered for middlemen also. I will explain that as we go on. Middlemen who buy let's say paddy millers, for instance, it's offered to them also. So some middlemen traders also make use of this. Okay. Right. So we will focus our discussion mainly on the agricultural segment because easier to, we won't go into the full details. We will try to focus on how we can offer these to this agricultural segment in our discussion today, right? So I was saying that Salam, if you ask what it is, you should be able to say it's a forward sale contract. Salam is a facility offered by Islamic banks based on forward sale contract, something like that. You should, at least minimum, you should be able to write about it, right? Salam is a product used by Islamic banks to offer facilities to customers based on the concept of forward sale, right? That is a very brief. If you can write all what is here in the slide, it's even better. But at least you should write this. So invariably, you know, we have 2 sessions, 2-3 sessions in this, normally 2 sessions. And we get people who either come for 1 session or, you know, they either come for the first session or second session. And sometimes they attempt to write answers to the question on the exam paper. And the question is, what do you understand by Salam? And there was an answer where the student wrote Assalamu alaikum, which is referring to the Salam, the greeting used by Muslims among them, right? We're not talking about that here. This is forward sale. So that's what you should write if there is a question on Salam. Don't say Assalamu alaikum, although I like the greeting, I can't give marks for that. All right. So we will go into details and look at how this works in practice, because the very concept of Salam is again linked to the real activity, not only giving funding, because what we are saying is Salam is a forward contract where you pay the price now, customer delivers the goods in whatever agreed period in future. But that doesn't help the bank, right? If I agree with the farmer that he will give us, if the bank agrees with the farmer, he has to give us 1,000 kilograms of tea in 3 months' time, 1,000 kilograms of paddy in 3 months' time. And for that, we pay today 1,000 kilograms into 50 rupees, 50,000 rupees. After 3 months, farmer brings 1,000 kilograms of paddy to the bank. That doesn't help the bank, right? Bank doesn't deal with paddy. So how do we manage that? For that, what we do is we appoint the bank customer as agent. He himself sells the paddy, brings the cash flows to us, brings the cash flow. He doesn't bring the goods to us. So there is little more variation to that. The standard definition of forward is we pay now, customer delivers goods in 3 months' time or whatever agreed time. But in practice, it doesn't physically, he doesn't bring the goods to the branch or the head office and stop the lorry in front of the Islamic bank and unloads the paddy. It doesn't happen that. Once he confirms, once the confirmation comes, I have 3,000 kilograms which I have sold for you, the bank sends a note saying, please sell and remit so much. And how do we calculate those amounts is what we are going to look at. So I mentioned about a price for the Salam is cheaper, meaning less than the cash sale price. Again, here the time value of money is incorporated in 3 types of prices. The cash price, the spot price is 100, deferred price is 100 and let's say 20, and the forward price is 90 or
Sir,
80. Or, yes.
Can I disturb?
Yes,
So,
please.
Salam, now, as you said, now the farmer comes to an agreement with the bank, Islamic bank, to sell paddy, stock of paddy in a future date at a the agreeable price.
Yes.
So, but since bank does not purchasing paddy, the farmer should have a seller, the buyer, to purchase that paddy. So
Yes.
then
Yes.
there is another party. So what is the buyer's role at the time of coming into the agreement. So the buyer has to have the seller, farmer have to have the confirmed buyer in the
Yeah,
market.
not at the, not that is not. Yes, you are absolutely right. After 3 months, bank won't accept the goods, but farmer should have somebody to sell. So that means there should be some market for these goods. Otherwise, bank will be in a position, not in a position to accept the goods. That is perfectly agreed. But that is not part of the initial contract. Initial contract that currently which is used, those contracts select goods which you can practically implement this, and paddy does not fall into a category where we can't deal in, meaning in case farmer can't sell, we can't find a miller or somebody to buy those paddy. That doesn't fall into this. So there is no the ultimate buyer doesn't come into the picture at the moment, at least how it is practiced in Sri Lanka. But there are, like I explained earlier, there are parallel Salam, meaning the same day in more advanced markets where there is commodity market active, there is a parallel Salam, meaning after bank enters into a contract with the agriculture farmer, same commodity bank gets into another parallel Salam where it covers its risks. But we won't go into that in details. That is not part of that is not how it happens in Sri Lanka, because we have less active commodity markets in Sri Lanka. Number two, we choose goods which have immediate sale value. So any reasonable type of paddy, if there is enough sale during the seasons, banks will get into that kind of goods. So that's the answer to your question. So there is no third party coming into that contract on day one. They answer your question?
Yes, sir. Got it.
Okay. So we will. I was saying about the time value. Time value. There was a question last session. Is the time value inbuilt into Islamic finance? Now this sale process, to some extent, inbuilds the time value of finance, time value of money, because different types of payment date, different types of delivery date will require, because that is a natural tendency of the market. If you buy on deferred, generally the prices will be higher than the spot price. If you buy on forward, prices will be less than the spot price. And you can understand that if you buy on a deferred sale somewhere, chances are, that is credit sale, chances are you will pay a little more. And if you pre-order something, for instance, if you buy apartment before it is constructed, you will pay a lesser price than after it is constructed. So that is natural in the market, with different types of price for the same goods. And that difference in price, which is technically the time value, will be made use of, in this case, by the Islamic banks, right? So on day one, the bank and the customer agree. We move on to the next slide. The bank and the customer agree the price of a given price to be paid for a given quantity of acceptable commodity to be delivered in the future, right? So we agree this is the type of goods that you are going to produce and give us. So the previous question there was whether it is only for paddy. It need not be. Even for manufacturing segment, this has been used with slight variation, and that is called istisna. Istisna, istisna. Istisna. which is again a type of forward sale, often used in the manufacturing segment, and it is also used for construction also. So here we agree specifically this type of paddy. This is the number of quantity, and you will give it to us in 3 months or 6 months or whatever time period that we are comfortable with. So that's the first contract. And then we pay for that. We pay for that. So on day one, the bank pays for that. So under the arrow number 1, you can also agree that bank pays to the customer. That bank pays the full price, right? I'll come to the word full price as we go on. So bank pays the price, and then customer, after the agreed time, delivery period, let's say after 3 months, he comes to the bank and says, look here, I had the 5,000 kilograms of paddy. Now you can take over. So what the bank will say is, okay, we don't want to physically take over the paddy. You go to the market, you sell the paddy and bring us the goods, bring us the cash. So sell the goods, and beyond anything beyond this price, bank might say, now we will calculate how to determine the price, how to determine the purchase price, how to determine the sales price. We'll calculate as we go on, and what to do in case of delays and pre-settlements. We'll look at it when we come to the question. So number 3, customer sells the goods in the market as the agent for the bank, and he comes and settles the cost, the capital, and the profit to the bank in number 4. So first payment of goods happens today, day 1. 2, 3, and 4 happens at the end of the maturity, at the time of maturity, because there won't be cash flows in between. So it's, in essence, this is used as a short-term contract for seasons for agricultural purposes, right? That's very easy to do that. It doesn't mean it can be only used like that. It can be used in multiple ways, but in practice, it's very easy to use for short-term purposes, where the bullet payment of the facility is done at the end of a season or something like that, for obvious risk reasons. So that's the type of contract that you can easily create using this type of structure. So arrow number 1 happens today, 2, 3, 4 happens at the maturity of the contract. Is that clear? Any questions on that? Right. There are a few rules related to Salam, Sharia rules. First is that goods should be sufficiently described. You should be able to say what type of goods you are purchasing in future. It's a condition of the contract. Because if there is some vagueness here, that leads to uncertainty, which is not acceptable in Islamic finance, right? So you have to say, what is the goods we are purchasing? What is the goods we are purchasing on day 1? So normally, whatever specifications you give is clearly mentioned. So it can be something like whatever BG1, whatever type of paddy or something like that. If whatever that can be practically defined needs to be defined. If it is a pen, manufacturing pen, what kind of pen is going to be manufactured, what is the ink content or something like that needs to be defined. So that is very important on day 1 to define the goods. Number 2, there is a condition that prices of goods should be paid in full. So if it is we are buying 5,000 kilograms. If we are buying 5,000 kilograms at 100 rupees a kilogram, right? If there is no question, please unmute mute your mics. Thanks. So the price of goods should be paid in full. That is a Sharia condition. I want to explain that a little. Let's say we are buying 5,000 kilograms of paddy. Each paddy is 100 rupees. The general requirement is that you have to pay this full 5,000 kilograms into 100 rupees into 5,000 kilograms. That is 5,000, 50,000, 500,000 rupees on day one, on the spot. You have to pay now. You have to pay. Now, that is not a practical thing when it comes to agricultural sector in Sri Lanka and in elsewhere also. Why is that? You give the farmer the full amount of proceeds that you're going to give. One is he doesn't need cash flows like that to start with, right? Because before at the start of the farming activity, he will want to clean the land, he will want to purchase some seeds, he will want to plow. So he will want, let's say, 20-30% of the initial amount to start with. Then during the period where the plant grows, the farmer will want for some fertilizers, for pesticides and things like that, another 20%, 30%. Then at the end of during the harvest, he will need money for harvesting, then processing, all that. So if you pay 100% on day one, you may invariably put farmer in some risks. But risk, he will spend all the money because he will have certain eating, drinking habits which may not be productive with lots of money in hand. He may not be able to keep the money with him and use in a judicial manner towards the full process of harvesting. So conventional banking, conventional banks give portion necessary for these different periods in harvest, right? Pre-harvesting, at the start of the period, during the growing of the crops, then harvesting and post-harvesting. So if you give funds like that, that may be helpful for the farmer and gives little more better financial discipline. That's the behavior we have seen. But this Sharia question, he says you have to pay the price of goods in full. Meaning, if you're buying 5,000 kilograms in our example and 100 rupees, you have to pay 500,000 rupees in full. So how do you solve that? Any ideas? So Islamic banks, if they want to do this transaction, one is to pay full, but if you know something like this is happening, the requirement is to pay in full, but requirement doesn't say that you should purchase the entire quantity of the farm, right? So you pay full, but you purchase goods on a percentage of quantity he can produce. So instead of purchasing, let's say, 5,000 kilograms, you start, if it is 20%, you start purchasing 2,000 kilograms to start with. Then during the harvest period, you purchase another 1,500 kilograms, and during the harvest and post-harvest, you purchase another 1,500 kilograms, but pay the full price per kilogram. So although the requirement is on the price, P into Q is the total sales. Now the Sharia requirement is you purchase the full quantity, full price, pay the full price. So what Islamic banks do is they don't purchase the full quantity. They will purchase the quantity in certain portions, so that they still meet the Sharia requirements, at the same time manage the actual risk in, for instance, in agriculture in Sri Lanka, for instance, so that the practicalities also can be managed to avoid any unnecessary risk here. Number 3, debt cannot be used as a capital. So if there is an already outstanding facility or something like that, that can't be used as a capital of Salam. So you have to give cash, and you can't say, I have given you an outstanding facility, all that facility will be now used as a capital for the new Salam. That is not permissible. Again, that goes back to the principle related to being specific on the capital. So Salam, you can't use a loan, outstanding loan, as a capital. You have to pay cash. So those are some of the Salam principles that is already embedded in Sharia, which has certain implications. So we use them carefully to manage. We don't violate any principles of Sharia when we actually do engage in a transaction. So in terms of purpose, used in agriculture to provide, we go into the nuts and bolts of the transaction. Stable price is provided prior to cultivation. That's the purpose when you are using in agriculture sector. Again, the amount of financing is limited by the value of the stock of underlying transaction. You can't give any amount. It is based on the harvest the customer can bring in. Offered predominantly short term, because nature of the cash flows is going to be the bullet repayment. So normally it's offered for short term. Pricing is based on discount to spot prices. So in our example of the pen, spot price is 100, forward price is 90. That 10 rupees is the profit for the bank. Documentation, product related documentation in addition to standard documentation is used. You can take Salam stocks as a pledge over Salam stocks, but stocks had to be produced, right? But technically that stock belongs to the bank in the first instance, because it is bank has paid for that to start with. But to have some control of sales, sometimes the pledge is used. Repayment, again, short-term bullet payment. Not possible to reschedule, not very flexible to reschedule, but could be taken into consideration by managing the initial price. I'll explain that a little more. You will understand that a little more as we do the question. So in terms of credit risks, so the underlying agreement is that customer will deliver the agreed goods in certain time, right? So you pay now for a goods to be delivered in 3 months' time, or 2 months' time, or 1 month's time, whatever time you have to deliver. Now, if that is the definition of Salam, nowhere does it say you have to produce yourself and deliver. All right? The agreement is it's a type of forward sale. I agree to purchase this pen from Mr. A in 3 months' time. I give him money today. It doesn't mean Mr. A has to produce this good. He can purchase from the market and give me also, right? That's the underlying transaction. But always good from a practical point of view, if you are doing for agriculture sector, always good to align it to cultivation stage, because it is unlikely the farmer is going to purchase the paddy from the market and give the bank. That is very unlikely scenario. So if you look at the yield, if you look at the cultivation stages and align the financing towards that, the chances of recovering your capital and the profits are much better. Although technically the contract doesn't say that farmer has to produce himself, behaviorally, if he doesn't produce, the chances of him buying from the market and delivering the goods will be relatively less. So that needs to be taken into consideration when you are considering the credit risk related to Salam. Number two, in terms of price risk, the commodity that has very high volatility, right, may not be the ideal commodity. I spoke about commodity as acceptable commodity. So generally, there will be some list where commodity which is highly volatile in price may not be the ideal commodity to use under Salam, right? In these days, when prices are going up and down, like the current situation, many commodities won't fall into the right structure for Salam transaction. Because the main reason is, if you can't reasonably predict or reasonably arrive at an average price, it will be difficult to price a Salam from a bank's point of view. So as such, generally choose commodities which have relatively less volatility in price. That's the main reason why you have to look at the price history, past history, immediate recent history to arrive at purchasing price. How to do that? We will look at because we will look at the spot prices and arrive at the forward price. So in order to arrive at the forward price, spot price has to be to some extent stable, or has to increase at some trend, so that we can look at. So I will just skip. Sorry, we'll continue. Let's say we have 3 products, A, B, and C, and 5 months we are observing their price. A has 5 rupees, 5 rupees, 5 rupees, 5 rupees for the 5 months. B has 2 rupees, 3 rupees, 5 rupees, and then 2, 3, 5, then 7 rupees and 9 rupees. The average of A and B will be 5 rupees average price, but the volatility in price B is little higher. So the volatility as calculated by, in case you all are familiar with the standard deviation, will be high, right? Whereas in product A, where all the 5 months the price is 5, there will be no standard deviation. The average is same as the spot values, right? Or very little standard deviation if one of them is 4.9 and the other is 5.1. So choose commodities which has reasonable volatility, which bank can manage its risk. That's the risk point number 2. Number 3, operational risks. First is good for the bank to have some kind of control over the goods inventory once the confirmation of production is done. maybe you can have some kind of arrangement where the inventory has some kind of pledge, where the bank has some kind of pledge over inventory if there is no other security. There is a storage with common bank can store them with some common agreement, right? Of course, the bank reach is important there. Number two, bank also has to take into consideration time to sell and recover cash, because customer can get away by saying, I have produced the goods, I have delivered it to you, my contract is over. Bank is not only interested in receiving the yield, receiving the harvest, bank is also interested in selling at reasonable prices and recovering its profit and cash. So customer taking the view that I have produced, I have delivered you, you look after yourself, will be an operational risk for the bank. So bank has to take into consideration when giving a facility like this, time to sell and recover cash also into the pricing when they determine pricing for Salam. So those are the broad or key risk parameters that you need to consider, product related parameters you need to consider when you are looking at a Salam transaction. Any questions so far on Salam?
So how do you decide that settlement price that is something on par with the market rates, or like do you add the price risk that you are taking to the market value and decide, or and which state do you decide that the settlement price, like based at the time of settlement or prior to the agreement, prior to granting the loan, do you decide the settlement price?
Good question. That is the next slide also asks you that question. So we take a discount from the current price, right? So if the current price is 100 rupees, you take into consideration in the same way like Musharaka, you take into consideration your required returns, and you take into consideration the time period from the day of disbursement till you recover cash, that time period. And then adjust for any possible volatilities in terms of the price and yield, and you arrive at that price, at the spot price. So when you take the spot price, all this needs to be adjusted. But what needs to be adjusted? Your required rate, the time period for which you are expecting the cash flows to come back to you. Number three, any volatilities in the yield and the price of the underlying commodity. We will see how it is done in the question, but all that needs to be considered and adjusted in the price we are paying for the goods to start with. Is that clear?
Yes, sir.
Okay. So what we will do is we will try to do this question. If you all can try answering this question, write down and answer the question. Then maybe we'll take 10 minutes. Now it's 2:52 by 3. If you can answer, then maybe I will work out, and then we can compare answers and see how this goes. This is again similar to a question that you might get in the paper. Again, it's a choice. You don't have to necessarily do this. But if you are interested in doing it, this is something like this question that comes to the exam. And if you're familiar with this, of course, you can handle exam questions. But having said that, it won't be the same question that will come to the exam. Yeah, it will be similar, right? The difference between same and similar. So the only changes sometimes I do is instead of paddy, it becomes tea, or instead of tea, it becomes sugar. So that kind of changes also sometimes I do. Sometimes I change the contents a little bit. the price, the kilograms, the hectares, or something like that. But that's more or less what we are looking at. And if you understand this question, you will understand how it works. And also, I mean, I have explained how it works. But practically, if you calculate, then you will know what's the underlying benefit for the bank and how the different risks could come up, right? So if you can take a few 10 minutes, maybe, yeah, okay, I will give you till 3:05. If you can do this, please, and then maybe I'll do it on the board. So let's read through this question and try to answer it. Says Mr. Roshan, Paddy farmer approaches an Islamic bank for a Salam facility on 1st of September for 300,000 rupees. So 1st of September is coming for 300,000 rupee facility. He owes 5 hectares of land, from which he can produce 3,000 kilograms of paddy per hectare during the season. He owns 5 hectares, from which he can produce 3,000 kilograms of paddy per hectare. 3,000 kilograms of paddy. So 15,000 kilograms of paddy is what he can produce. Right, his harvest will be 15,000 kilograms. The farmer confirms that paddy could be sold at 35 rupees per kilogram. Sold at 35 rupees. Assume the bank will extend the facility for 4 months. Assume bank will extend the facility for 4 months. At 15% per annum. 15% per annum. So the period, expected rate, and the amount of funding. Assume the bank is willing to extend. Describe what is meant by a Salam facility in Islamic banking. So here again, you have to define what is Salam. You have to say it's a facility given by Islamic banks based on the concept of forward sale. So something at least to that extent you need to say. The Qt has the more detailed definition. You can use that. You can use the diagram to show how it works, the process. So that's the first question. What is the maximum amount the bank could offer as a facility for this transaction? If the forecast price and quantity of a farmer if the forecast price and quantity given by the farmer are correct. Now let's assume this is all what the customer said. He can produce 15,000 kilograms of paddy. He can sell it at 35 rupees. If he says that, assuming that he doesn't want 300,000, he wants the maximum amount he can take for this facility. What is the maximum facility we can give, provided that we need 15% per annum returns? So the answer to this question is not based on the security he gives, we will decide, or not based on his credit profile or credit score or anything like that. Of course, that determines how much you give to anybody, right? But based on the product structure, what is the maximum we can give if we agree that he can sell these proceeds for this 15,000 kilograms at this price, and we want to give a 4 months facility at 15%, what is the maximum we can give as an Islamic bank to him? Why is that important? That is important because beyond, we said in our discussion on Salam that the maximum amount we give is limited by the underlying transaction. If he can sell only these goods at, let's say, 15,000 into 35, how much is that? $525,000. How did I get that? This into this. Is that right? $15,000 into 35 is 525,000. That's what I think. So if he gets the maximum amount, this is the maximum sales proceeds he is going to get, right? If his forecast for the yield and the price are correct, this is what he is going to get. So anyway, the bank can't give anything more than this. But this includes the capital and the profit, or in conventionally the loan amount, the capital of the loan and the interest. Both, including both, only is this proceeds amount, because that's what finally we will get. The bank sells the goods to the customer. Sorry, the bank pays the money to the customer at the outset. After 1 month, or in this case, after 4 months, he comes back, he will deliver us goods. We will tell him to sell in the market, which will be at 35 rupees. When he sells in the market, he will get 525. So this is after the harvest. Keeping our 15% per annum markup also, the profit margin also is this amount. So the question now is, what is the maximum amount for this transaction? Means this is the capital plus profit. So we have to find out what is the total amount that we can give if this includes capital and the profit. So in order to arrive at that, first we have to arrive at the rate. If for 15% is for 4 months, it will be 5%, right? 15% per annum means for 4 months, 5%. How did I arrive at it? 1/3 of this, right? So this is capital, let's say X plus 0.05X. Correct? That is this. So 1.05 X equals 525. X equals 525 divided by 1.05. How much is that? $500,000. Did you all get that right? So if I give facility for 500,000 today, he can sell and come and settle me after 3 months 525,000. I would have got my markup during the period, right? That is, if he doesn't want the 300,000, this is the maximum I can give for the given amount of paddy at the given price. That's the first question. What is the maximum amount banker could offer as facility for this transaction? If you give anything more than 500,000, you will not be able to recover the expected profit within the period. If you give little more than 500,000, 505,000, the profit that you need on 500 to 5,000, you won't be able to recover from the sales proceeds. So first we have to understand that aspect. So beyond a certain level, we can't give facility, Salam facility and recover back for this transaction, right? So maximum you could give is this, maximum on a Salam facility. So first let's establish that. So if you get this amount wrong, then obviously Salam won't be a profitable transaction. Now that's the first question. Did everybody get it right? So without taking into consideration, he's only asking for 300,000. We are forgetting that for the moment. We are only looking at the sales proceeds, which is based on the harvest and the yield. We are arriving at the maximum amount possible. Is that clear? Any questions on that? Yeah, so we move on to the next question. What is the maximum amount a prudent banker would offer as a facility for this transaction if the maximum variation in yield is 5% and variation in price is 10%? Now we are bringing in little uncertainty into this. Still, we are not talking about 300,000. We are talking about the paddy, but first question is being little relaxed, right? First we said, assume the bank is willing to, we took farmer's word for his amount of yield and amount of price, right? So that gave us the sales proceeds. Now we are not so sure. If you are 100% sure of farmer's price and the yield, you can do this transaction. But when farmer says 15,000, it could be 5% plus or minus. It could be 5% plus or minus. And when farmer says 35 rupees, it could be 10% plus or minus. Right? This is the scenario. Now, the first question, we are confident when he says 35 rupees and 15,000 kilos, that is what we will get. Now we are not so sure. We are introducing a little uncertainty into the transaction. And now we are asking how much maximum we can give now. How much maximum? So again, the question is how much maximum we can give. So as prudent banker, we are not going to consider the plus sign, right? Why is that? If it comes more, that is better for us. But our risk is when it goes down. So 5% of 15,000 is 10% of 335 is 350. So the actual yield could be 750 kilograms plus or minus. Actual price could be 3 rupees and 50 cents plus or minus 35. So this could be 38.50 or 31.50. This could be 15,750 or 14,250. Correct? But we will only consider the lower case. Prudent banker, that's the message we are going to tell. As prudent banker, meaning our risk will be if we get lower yield and lower price. We don't have a risk if we get higher yield and higher price. That's no risk. Risk is if we get these two, a combination of these two. So that is sales proceeds will become 14,250 into 3,150. How much is that? Anybody has answers? $448,875. This is the expected sales proceeds. Yeah. Is that clear? This step up to 448, which is equivalent to 525 in this previous example, previous question. Is that clear? Any questions on that? So if this is capital plus profit is 480, 48,850. What is the original capital? 448,850 divided by 1.05. How much does it work to? $427,500. Am I getting the numbers right? Any clarifications you all have? So first thing, before we consider the borrowing amount, the amount customer wants to borrow and all that, first we are considering, irrespective of that, what is the maximum we can give as facility if we are to take into consideration only the sales proceeds, only what he is going to get if we are going to take into consideration, given that we can give a facility for 3 months and that our rate for this kind of facility is 15% per annum. How much maximum we can give as facility is what we are working on. First instance, we worked out without any uncertainty on the amount of yield, or yield here means the agricultural yield, the paddy that we can harvest and get, or the price for that paddy without taking into consideration any volatilities there. If we work out, maximum we can give is 500,000. But if say the prices change by around 5%, the yield changes around 5%, and the prices change around 10%, we take the minimum case where we get lower yield and lower price. That is very minimal case, and we can arrive at the minimum amount, maximum amount we can give. So if you give for 427,500, even if yield he doesn't get, we will end up still recovering our capital and profit. Here I want to explain something again, which I referred to earlier. When you enter the contract, you will enter the contract for 15,000 kilograms. What the customer says as he is going to deliver, right? But even if he delivers 14,250, you would be able to get your profit, your capital and the profit back. It doesn't mean you enter into a contract for 14,250. Although the contract will be 15,000 kilograms in paper, if the actual yield is only 14,250, chances are the farmer is not going to purchase the balance from the market and give the bank. Chances are farmer will say, that's all I can produce, I'm going to stop at that. So that's why although you can contract for 15,000, because that's how it happens contractually, that is right. In more advanced commodity markets, if you enter into a forward contract on commodity, you have to provide that total amount of the contract we entered into. I'm sorry, we will come in 15 minutes to 15 minutes and continue this after the break, right? We'll continue this after the break. at the transaction of forward sale and seeing how it can be implemented to offer facility to customers. So unlike just giving agricultural loan and charging interest, we use the sale contract to create a similar effect, right? We use the sale contract to create a similar effect. When you are using the sale contract, you can't do the same thing as giving a loan contract. The risks and the nature of the risks and the returns that you will earn will be different. Different in the sense it can be the same percentage, but how you earn the returns will be based on the purchase price and sales price rather than a fixed percentage. Right? That's how to do that is what we are looking at here. In the first case, what we looked at, in the first case that we looked at, it is the price and the quantity given by the customer is acceptable to us as such, and we assume there is no risks there. And if you do that, we taking into consideration the return that we need, that is, which is at 15% per annum or 5% per year, we arrived at the possible selling price, right? Possible purchase price. How did we do that? We took the total sales proceeds and took the profit out of that. So we know maximum we can purchase is, in our case, 500,000 rupees in the maximum amount. But if you introduce more volatility, potential risk in yield and price, then we will have let's say another amount, right? Which is around 427,500 in our case, because we are introducing additional risk, we are getting lower amount. But again, this calculation of 420,000 is very cautious, because we are taking the lowest price possible and lowest quantity possible. So in that sense, it is very low in number. The amount, one can argue, is very low, 427,000, because we are being very safe. In the sense, we are taking the lowest possible quantity, lowest possible price, and giving a price. To the extent somebody can argue, customer may not get the right proceeds. Customer is getting lower proceeds. But the level of margins in the market, that may not be so, especially in Sri Lanka. But that may be one way of looking at it, right? So we had to be practical in that sense. But this is an area where if we take the lowest possible yield, lowest possible price, the chances of bank losing money will be mitigated to the high end, right? Very low risk profile, although there are still other risks that bank will need to look at. Okay, let's move on to the next question. So it says, what is the maximum, question number 4, describe the key steps in offering a Salam facility to the farmer in the above case, including the agency and incentive. So in this case, so first point, so if we take the case number 2, that is with the variations, the bank will contract to purchase 15,000 kilograms of tea, or in the first case, bank will contract to purchase 15,000 kilograms of tea. Customer brings 15,000 and pays him 500,000 rupees. 500,000 rupees to purchase 15,000 kilograms of tea. on 1st of September, on 31st December, customer sells the goods and brings in 525,000. Bank will appoint, before that, customer confirms he has produced the goods. Bank appoints him as agent to sell those goods and bring in the cash. On 31st December, he will bring the cash of 525,000. Something like that will be the necessary step in describing a Salam facility. Of course, it's there in the tube on top, two slides above. You can use that slide to describe it. So agency is after customer confirms production or availability of goods, before goods being brought into the bank appoints him as agent to sell the goods and bring in the cash. Incentive means, in case, let's say, when the customer sells, although bank specifies we have to sell at 35 rupees per kilogram, if he sells at 40 rupees per kilogram, bank will generally say anything beyond that is your incentive. So instead of 525,000, if he brings 550,000, bank will say balance is yours. So 525,000, 25,000 additional is given to the customer as incentive. So what happens if the prices are less? We'll come to that in a minute. And so we go to the next question. Describe steps to be adopted by the bank in case of delays and pre-settlement. If there are delays, now we have taken into consideration in the previous case, we have taken into consideration that when customer says within 4 months, we have taken into consideration 4 months for the pricing. The whole pricing happens based on 4 months. But if the customer says 4 months, and chances are he might delay for a month or so, our pricing needs to take into consideration that possibility too. So there could be some adjustment to the 4 months that customer says he can sell. That's one way of adjusting for any delays. The other is in the second case, if you have only given 427,000, whereas the total proceeds based on customer's original price comes as 525,000, we still have room to take the price for any delays, because remember the underlying contract is that customer delivers us goods. Now, once he delivers the good, anything you give for him is his incentive. Anything additional beyond your scope, what you require, you can give him as incentive. So if there is delay and if there is a buffer, I mean the sales proceeds minus our expected return and capital, there could always be some adjustment done for the delays. So you can charge for delays in this case if there is buffer. There is no buffer, of course, you can't charge for delays. If you have given 500,000 rupees and the sales proceeds is 525,000, if the customer delays by 1 more month, you have no basis to charge him more. But you have given 427,500, whereas the sales proceeds is 525,000. If there is a delay, you can charge whatever based on whatever the rate you want to charge. You can charge more because you have room there to charge. So that's the difference when it comes to delays. Delays, if there are a buffer in the pricing, you can still charge for delays. If there is no buffer, you cannot charge for delays. Pre-settlement is not technically, because it's your goods, the bank's goods, there is no technically he is selling your goods and paying you back. But he has sourced from the market or produced much earlier than you need. Of course, you consider some discount for that. Of course, taking into consideration any pre-settlement risk. So instead of 4 months, he brings in the goods and sells by the 3rd month, end of 3rd month, 30th November, he sells and has the cash. Then of course you will not charge the full amount. You will give him further incentive to take into consideration pre-settlement, so that he's not taking the full tenor, but not exactly for 3 months. You will take into consideration some compensation for pre-settlement risk. So it won't be exactly 3 months. It will be little more, but it won't be 4 months. It will be little less. That's a normal practice. So that is question number 5. Question number 6: if the bank disperses 300,000 total invest 300,000 against the total harvest of 3,000 kilograms, calculate the profit or loss if the bank disperses 300,000 against the total harvest of 3,000 kilograms. So 10 rupees is 30,000. 100 rupees is 300,000 rupees. What would be the profit or loss from if the paddy price falls to 19,000 per kilogram? There seems to be some mistake, some typo. Let me try that again. So what this says is bank gives 300,000 against 3,000 kilograms. It should be 15,000, I think. Against 3,000 kilograms means 100 rupees per kilogram. So if you are to answer that question as it is, it will be a huge loss, because if it is 3, I'll exactly answer the question what is here, but it's a typo. If it is 3,000 kilograms, so bank is taking a price of 100 rupees per kilogram, correct? Because 3,000 rupees per kilogram, 300,000 means 100 rupees per kilogram. So if bank disperses per 100 rupees per kilogram, and the price falls to 19 rupees, meaning he sells the 3,000 kilograms at 19 rupees, how much will he get? 0, 0, 0, 60, 50. So bank will have to bear a 243,000 rupee loss. Right? How did I calculate 243? According to the question, bank expected 100 rupees per kilogram, right? Meaning it gave for 3,000 kilos 100 rupees. The correct way is total harvest of 15,000 kilograms. Or total harvest of 3,000 kilograms per hectare would have been the right question, but of course there is some mistake. So if you use the face value of the question, 3,000 kilograms, 100 rupees per kilogram bank has sold, but the price is now 19 rupees. So if the price you gave for goods is 100 rupees and somehow it fell to 19 rupees, bank will, so that price fell by 81%, bank will incur the loss. Because remember, the agreement is not for him to give us profits. The agreement is he has to deliver, the customer has to deliver the quantity we agreed of the commodity we agreed. So once the customer delivers the commodity, if the prices fall, the loss will be borne by the bank. So it is up to the bank to study the prices and ensure the prices are reasonably reflected. The prices it gives are reasonable so that it doesn't incur loss. But for whatever reason, if the prices fall for whatever reason, of course, bank has to bear the losses related to that transaction. So normally a partnership transaction has profit or loss possibility. Even in a forward sale such as this, there is a possibility of the customer bearing some kind of loss. The bank bearing some kind of loss if the prices fall beyond the expected price, right? So that's the answer to that. So actual answer is 243,000, which is the loss which bank will bear if the paddy prices, which bank expected to be at 100 rupees, falls to 19 rupees. From a credit perspective, how is a Salam similar to and different from a conventional cultivation loan? So then here also you may have to write a comparison. One is nature of contract. A Salam is a forward sale. Cultivation loan is a loan contract. Here returns in Salam is based on the sales price of the commodity, underlying commodity. Here, of course, returns is based on the interest agreed. The purpose, cultivation loan is both are given for the similar purpose. For cultivation, for agriculture, Salam can be given. Cultivation is also given for agriculture purposes. Returns, of course, based on the actual sales price of the underlying commodity. Here, it's based on interest. Losses in conventional credit cultivation loan, there is no concept of loss. Whereas when it comes to Salam, there could be loss, which we saw in question 6. There is possible loss. So again, based on that, if you are talking about collateral, you can take any collateral on both facilities. So again, it's a similarity. So similarity in purpose, similarity in collateral, but amount recovered, the difference, of course, under collateral is that amount recovered is based on the amount due to the bank based on Salam calculation. So Salam, if the amount due in this bank, in this transaction, if the loss is 243,000, the customer has to pay the bank only 57,000, irrespective of whatever the collateral you have taken. But all types of collateral can be taken, mortgage can be taken, but if it is more practically, it is only the pledge of the stocks that can be taken. So all that are similarities. So something like that, similarity and differences of conventional loan based on purpose, based on tenor. You can have similar tenor for agriculture purposes. Even the pricing could be similar. But in terms of actual returns, in terms of losses, in terms of crystallizing the collateral and recovering, you have to have, there are certain differences that needs to be captured here. So that is roughly how exam question can look at. So we have looked at a Musharaka question. This is a Salam question, and as we go on, we will try one more question at least, so that you will have 3 questions, out of which 1 could come for exam as an optional question for you. Right? Any questions so far? No? Right, okay, so we'll move on. So we had 4, we'll finish at 5:30. We'll try to be little fast. We'll try to do 1 more product in detail and more. So next type of products that we are going to talk about is for individuals. Again, it is possible to give facilities for individuals in Islamic banking also, as you all know. So, sorry, I need to share the screen. So for the individuals also, we can provide facilities. So again, same as what we talked about in the business lending, we can give housing, leasing, and some kind of asset finance. But I explained the bias towards little less less focus on more liquidity products, such as, let's say, if you take individual's case, an example of pawning or things like that, are little limited. Standard contracts doesn't allow, so you have to do some combination of contracts to offer products like that. It is offered in Sri Lanka and in countries like Malaysia, Bangladesh. There is that kind of products. Not available. Pawning is not available in Middle East, as far as I know. But these are type of things that standard Islamic finance contract doesn't offer, but it can be structured by individual banks. Again, in terms of amount, it's restricted to underlying transaction. Tenor can be short-term, medium-term, long-term. Pricing is market product and market-based. But some products don't have the flexibility of changing the pricing, so that needs to be taken into consideration. Again, everything else we have discussed this, so I will move on to the next product, which is lease and called Ijara. So Ijari is a product where we use, which comes from the understanding that the bank, Islamic bank, offers a physical asset for leases the physical asset to the customer. Now, even the conventional bank's lease is not a loan contract, is a lease contract. And it's by nature, the lease contract is very close to Islamic finance contract. If you ask me what is the conventional banking contracts, which is closest to Islamic finance contract, one answer would be lease. Because even in conventional banking, lease is not a loan. Lease is not a loan. Lease is asset financing. There is an asset, underlying asset involved, and that asset is being given to the customer for a repayment of rental. But the Sharia view is that how it looks at it is that somebody owns asset without selling without changing the ownership of asset, without selling the asset itself. That asset has certain usufructs which can be rented out to somebody else. The asset has certain usufructs which can be rented out to somebody else, which can be given to somebody else. And for that usufruct is given to the lessee by lessor, the owner of the asset. And for that, the lessee pays a rental. And so the usufruct or the benefits of asset is what is given to the customer. That's the nature of, that's the thinking behind the contract of ijara, contract of lease, which is acceptable. The conventional ijaras, conventional leases, unfortunately, although the underlying contract is acceptable from a Sharia point of view, bring in so many clauses of interest into the lease contract to the extent it is almost converted as a loan contract. You bring in an asset contract of you bring in interest clauses to ensure the payment of installments and delays and all that. That becomes not acceptable from a Sharia point of view, right? Otherwise, a company leasing out something is in general inherently acceptable from an Islamic finance point of view. Let's say I own this building, this particular classroom I lease out. So ownership is with me. The benefits of using this classroom, the usufruct it's called, the benefits of using this classroom is being rented out to me by the IBSL, right? So that is perfectly okay from a Islamic finance point of view. But you can't bring in so many interest clauses into that contract that it looks like almost like a loan. That is not acceptable in Islamic finance. So that's essentially the difference. And between a conventional lease and a ijara and the Islamic lease. And stemming from that, the customer pays for the usufruct of the asset. If the usufruct of the asset is not available, customer doesn't have to pay a rental. So again, if the contract is for the usufruct of asset, let's say I want to lease out a machinery, till the machinery comes into the factory of the customer, and he is technically available, it is available for him to use, the Islamic bank can't charge rental from the customer. Even conventional bank may not charge rental, let's say on a machinery lease, till machinery comes into the factory and customer is ready to use. It may choose not to charge. But if it chooses to charge from the day it disperses money for the import of the machinery, it can still charge for the rental, for the lease. But in the Islamic bank's case, till the customer has possession of the usufruct of the underlying asset, Islamic bank cannot charge any rental for that lease. Of course, lease can be adjusted to take into consideration any period customer bank is out of the money. Lease can be changed, but the principle is you cannot charge any rental for a period where the customer does not have the usufruct. Similarly, let's say for a manufacturer's default, if a machinery does not work due to manufacturer's default, not due to customer closing down the machinery and keeping, when he has access, not due to that. If there is a genuine default, manufacturer's default, again, the Islamic finance view is that the usufruct is not available to the customer. As such, you cannot charge rental on that transaction. So those are the brief ideas that I think brief definition of what ijara or lease is from Islamic finance point of view. And I would like to reiterate that it is in the same way lease is different from loan in conventional banking. As such, it is more closer to Islamic finance transaction. The conventional loan also, conventional lease also, because conventionally also the financial institution provides an asset, provides its asset-backed financing. As such, it is possible. But only thing is, conventional leases bring in so many clauses of interest in the installment. It almost gets converted into interest-based transaction, which again is not acceptable to Islamic finance.
So, a small clarification.
Yes, go ahead.
When you are leasing, giving a lease facility to a vehicle for personal use, what is the calculation of profitability under this facility?
Yeah, profits can be calculated based on conventional rate, benchmark, anything can be used. So as long as the rental can be a fixed amount. So in our practically, even on conventional, let's say for 100,000 rupees, you pay whatever you agree on a rental, no, like 3,000 rupees or 5,000 rupees or whatever that amount is. I can't remember top of the mind. So something similar can be given also. So if you are buying if you are taking a lease for 100,000 rupees, your rental will be 5,000 rupees. Something like that can be agreed. Or you can say rental will be benchmarked to such and such a rate, AWPLR plus 3%, which will work out to this much. That is especially if it is if it is machinery and things like that. That can be agreed in the anyway. There is no restrictions on that, because rental can be absolute amount or a benchmark amount from an Islamic finance perspective.
Are there any published rates on that, or depending on the customer to customer change?
No, that depends on the banks. So some banks, it is based on the asset. So they advertise for 100,000 rupees, 5,000 rupees or something like that. Some banks, they choose based on customers and do. Even the ijara contract per se does not kind of restrict what you can charge. It doesn't restrict. So you can charge a fixed amount, you can charge a percentage, you can have bandwidths. For this type of customers, I will charge 10%. This type of customers, I will charge 5%. Not customers, maybe based on asset classes. For registered vehicle, I will charge this. For unregistered vehicles, I will charge this. For three-wheelers, I will charge this. For motorbikes, I will charge that. So based on asset classes, you can charge anything. So there is no restriction which is unique for ijara that is different from the conventional practice. So you can charge the full amount, you can charge fixed amount or a benchmarked amount. Depending on the customer, depending on the asset class, you can charge different amounts also.
Okay, thank you.
Right. Any other questions? Okay, so the bank purchases the asset, right? And it rents it to the customer. And once at the end of the ijara period, once the customer settles all the amounts due, all the rental due, of course the bank gives the asset as transfers the asset as a gift, right? That's how it's structured. It can be structured, ijaras can be structured as a financial lease, as an operating lease also. Ijara can be used as operating lease also at times. So even for hire purchase agreement, I understand some financial institutions use ijara too. So the concept of ijara per se does not tell the underlying legal structure or risk reward transaction. That now difference between an operational lease and a convention operational lease and the financial lease is the amount of risk and rewards that is being transferred, and those are not defined in ijara. So as long as how you structure it, you can structure either financial lease or operating lease. Similarly, if legal implication related to the hire purchases, if you can structure it within the ijara, you can offer hire purchases on ijara too. So there is no restriction in that sense. It's a broader underlying asset financing that based on some benefits given to the customer, some use of product given to the customer, you need to charge. That's all ijara says. The underlying risk reward trade-off, underlying legal framework that you want to use, whether you want to use a particular law A or law B, all that is flexible for the financial institution that is going to use the concept of ijara. All right. So again, this question was asked earlier: what kind of rental can you charge? It can be fixed amount. I see some banks advertising for 100,000 rupee ijara, you pay monthly 3,000 rupees or 5,000 rupees or whatever that amount is for so many years. So it can be a fixed amount that can be taken into consideration. Or similarly, when it comes to a lease of especially things like machinery or some commercial leasing, you could use some benchmark rates also. AWPLR +3 or whatever that rate is, right? That can be used. Because you are using AWPLR, average prime lending rate of the banks, or it doesn't become non-Sharia compliant. It can be a conventional interest benchmark, but it doesn't become Sharia non-compliant, because what you are doing is you are charging rental on an underlying transaction which is acceptable. In terms of maintenance cost, there is a requirement in Sharia that that if it is of the nature of not a regular maintenance, meaning at every 5,000 kilometers or whatever you have to service your vehicle, you can't go to the bank and say it's your vehicle, now you pay for the maintenance. Not like that. But if it is by nature, especially in case of let's say some manufacturers default and you have to restore it, cost like that, from a Sharia perspective, the bank says, the Islamic finance rules say that the owner should bear. Now that is sometimes practically difficult for the banks. So what they do is, if that happens, so if customer has to maintain, and he knows Islamic finance and comes and says, look here, you have to bear the maintenance cost, bank will say, because of the current repairs, only for next month, we will increase the rental by 1 month so much, which is equivalent to maintenance cost. So they get away based on understanding that if there is sudden additional charges that comes in, there could be some changes in the rental beyond that, right? So Ijara can also be used as a sale and lease back arrangement. That is, if the customer wants to buy a new asset, you can use Ijara also, lease contract. The same way, customer already has an asset which is fully owned by him, not leased to anybody or anything like that. He can sell that asset to the bank and lease back also, sale and lease back, right? So in order to existing asset, he can monetize that also. That is also possible under the Ijara. So if you look at Ijara, like I said at the outset, it looks very close to conventional leasing. Because even conventional leasing by nature is not a loan contract and very close to the principles of Islamic finance. Only problem with a conventional insurance, a conventional leasing though, is that we have changed that contract of renting out, of leasing out assets. We have converted that into we have tried to convert more into a loan contract, which is not acceptable in Islamic finance, right? So again, in terms of nuts and bolts of the transactions of Ijara, the purpose is you can offer operational or finance lease. I spoke about that. Underlying risk return arrangements or legal arrangement can be incorporated. Amount of financing is limited by underlying asset, which is the case in the conventional leasing also. Subject to prudential and regulatory requirements. Of course, in Sri Lanka, there were certain restrictions at some point of time, how much you can give facility for, let's say, new vehicle, let's say for the registered vehicle and all that prudential regulatory requirements is subject to that. You can give full amount of the asset as lease. Right, subject to the regulatory requirement. There is no restriction from Sharia to say you can only give 80% or 90% or 100%. Subject to your own prudential requirements, meaning bank will have general limit, banks will have limit. Let's say finance companies decide no limit 100% asset value. That also can be possible, but subject to the applicable laws and regulations. So Ijara itself doesn't limit the Islamic lease. It doesn't limit anything like that. It is up to you. Have to ensure as long as you abide by the laws of the country, the regulatory requirements. There is nothing stopping you from the lease to how much money you can give, but it cannot go beyond the value of the asset. That's what this point means. Tenor can be long-term based on useful lifetime of the asset. So that can be longer tenor. Pricing could be fixed or floating. We discussed that. It can be benchmarked. It can be fixed. It can be revised quarterly, annually, whatever. Documentation, same standard documentation of lease plus product-related documentation. Collateral is often the leased asset. That is the collateral. The registered bank registered as the absolute owner. Bank will keep the CR book, and at the final settlement will be handed over to the customer. Repayment in equal installment, that is the regular in the same as conventional lease. Let's say I take a vehicle which is 10 million rupees. I pay monthly 100,000 rupees for next so many years. But that is the rental, that amount, but it includes a capital and profit portion. Anybody who is familiar with accounting will understand that if I buy a vehicle for 10 million rupees and bank says your installment is 100,000 rupees, that installment is broken into capital and profit portion, and profit portion is initially high, capital portion is low. As the tenor increases, the profit portion reduces and capital portion increases, and finally, when all the capital is recovered, bank gives the asset to the customer. Rescheduling possible to reschedule also. You can't charge extra, but you can increase the rental, and you can also extend the tenor because underlying asset is available. You can reschedule transactions too. So those are some of the key features of Ijara. Any questions so far on that? So again, in terms of risks, asset classes, let's say vehicle lease is something much more easier, because unless it is condemned in an accident or something like that, you can generally keep on charging for the Ijara rental for a vehicle, right? But when it comes to machinery, asset classes which cannot be, let's say, for whatever reason, made in Germany, brought into Colombo after 3 months, it doesn't work, and you have to either get down a German technician or send the asset back again to Germany. Then that creates certain question marks on the principles of Ijara, because unless there is a usufruct accruing to the lessee, the owner of the asset, lessor, cannot charge rental, right? So if it's very specialized asset and for some reason it doesn't function, there is a malfunction, not because the customer hasn't maintained. If the customer hasn't maintained the asset properly, of course, the bank can continue to charge. But there is some manufacturer's default or some problem, and 3 months asset is kept as non-operating. Technically, from a Sharia point alone, bank cannot charge any rental during that time, because banking charging for the usufruct, not for the capital out on day one. Bank is charging for the usufruct given to the customer, and for that, if the usufruct is not accruing during that time, you cannot charge. I want to clarify here also. Let's say I rent out this particular classroom. The person who took the rent keeps it closed, does not utilize. That is not my problem. I can keep on charging rental. But if he utilizes, he has to pay, even as long as he has access to that usufruct, the customer has to pay. But after giving on rental, something happened and this becomes totally unusable. In that case, of course, since usufruct is not accruing, I cannot charge Ijara rental. That's the underlying thinking. So to avoid asset classes that cannot be maintained satisfactorily is a good way to ensure that your repayment of your facility continues properly. Price risk, of course, can be benchmarks, since these are longer term contracts, more than 5 years, 3 years, 5 years, and more. It is good to benchmark on an acceptable reference rate, AWPLR or PR or something similar could be used to mitigate price risk changes in rates. Operational risk, of course, maintenance is to ensure maintenance, monitoring of maintenance is useful, and other operational matters related to the asset to monitor them. That will be useful to minimize any operational risk. So with that, we can conclude our discussions on lease, ijara. Do you all have any questions on that? I have a question, but we won't go into that because we will skip that, taking into consideration the time. But broadly, I have explained how a ijara works, which is similar to a conventional lease. That's what I have said. I've also highlighted some of the differences because what we are charging for is the usufruct. What the Islamic bank charge for is the usufruct. If the usufruct is not available, Islamic bank cannot charge. That's a simple definition, a simple difference. So that can be applied before the start of the contract. If you give your funds out on day one, although even conventional banks sometimes don't charge, technically, if you want, you can charge from day one before the asset comes to the control of the customer. But Islamic banks cannot. Even during the time of operation, if for whatever reason usufruct becomes not available, again Islamic banks cannot, whereas conventional banks can still charge if they choose to. So those are relating from the first definition. These are instances where the differences come in. Any questions? Right. So we move on to the next product, which is again sale-based product. So I explained three types of sale. One is a spot sale, one is a deferred sale, one is a forward sale. So what we discussed previously is forward sale. When we discussed Salam, what we discussed is a forward sale. So you can purchase forward, sell on spot, and make money. And that transaction can be, we saw in the context of financing agriculture, that transaction, buying on spot, buying on forward, selling on spot, and making money can be used by Islamic banks to create that link between real sector and financial sector without just giving loan and charging interest. But having said that, we saw it's the different types of risk that could come up and the returns, how they could change from the original amounts that bank has in mind in terms of expected returns. Now we are going to look at the other sale, which is murabaha, which is deferred sale, where bank purchases on spot and sells on deferred. So it's the other side of the sale. So we saw three sales. Forward sale we have already covered. The name of the forward sale is Salam. Now we are going to see the deferred sale, which is the name is murabaha. Murabaha. So this is, I think, the third product starting with M. We saw musharaka, which is partnership. We saw mudaraba, which is a special type of partnership, and now murabaha, which is a deferred sale. So better to remember those terms or use only pure English, right? But don't confuse both. Use pure English, still okay. Use, if you are familiar with the term, use that term, that's fine. But if you combine, then sometimes you can get it wrong, right? So Murabaha is a type of sale where cost and the markup are disclosed, where you pay on spot and sell on, pay on spot and sell on, buy on spot and sell on deferred basis. So I said two things. First is Murabba sale is where the cost of sales and the markup are disclosed. So we spend 100 rupees. If I am to sell in a Murabaha, I buy this pen from Mr. A for 100 rupees and tell Mr. C that I'm selling this pen, which is 100 rupee in cost, at 120 rupees. So I have to disclose my cost and the markup to the buyer. So that creates a little bit of a question mark. It's like you going to Cargill's and looking at this pen, and it has a, let's say, a sales price 100 rupees. You ask the Cargill's, the sales girl in Cargill's, how much did you all buy this for? Because you are looking for the markup. And the Cargill sale girl will say, if you won't buy this, or keep it there and walk away. But we don't disclose the cost price, right? Because nobody will, there is no requirement to disclose the cost price. Sorry. So this is also something similar, but if you ask me how can you, so what is the rationale for that? The rationale for that is, if you are buying something at 100 rupees, if you disclose the price, disclose the markup, it will facilitate even people who are not familiar with that market to enter into that market. That's the understanding of why profit markup should be disclosed here. It should be known to the buyer. If you are engaging this type of sale, Murabaha sale. If you are not engaging this type of scale, it is not required. Normal sale, it is not required. But to go back to my question, if you ask me how much markup does Cargill's keep, in modern terms, I can tell you what their gross margin is. I can look at their financials and tell you what their gross margin is. Of course, I can't tell exactly for this pen how much they kept. That I don't know. But overall, what is the gross margin, I will know. But here in this contract, what we say is, what is our gross margin is disclosed to the customer. That's what the contract is. So that's what a Murabaha is. Price plus markup is explained to the customer, right? So again, the process integrates the real sector with financial sector, meaning the bank purchases goods from the supplier and sells with a markup to the customer. So if bank purchased the goods at 100 rupees, it keeps a markup of 20 rupees and sells it to the customer, right? And for a time period. let's say for 3 months. So if the bank purchased the pen from the supplier at 100 rupees, it pays the supplier immediately 100 rupees, sells to the customer, bank's customer, at 120 rupees, and says you can pay in 3 installments of 40 rupees over the next 3 months. So customer pays 3 installments, 40, 40, 40. So together 120 rupees he pays. Bank gets profit of 20 rupees. All right. So by linking with the supplier, bank creates that link with the real sector. But after the second transaction, bank buying from the supplier, bank has the pen. Now bank sells to the customer, bank keeps a markup and sells. Both these transactions happens on day 1. And if it's a 3-month transaction, after the 3rd month only, the payment comes in, right? Unless it's an installment. So in this case, if the bank purchases at 100, sells at 120, the 120 rupees, let's say it's a bullet settlement, 120 rupees comes after, let's say, 90 days comes in. The buying and selling relationship between the bank and the customer is in step 1 and 2 only. After that, the relationship is debtor-creditor relationship. Debtor-creditor relationship. So there could be no changes to the price after that. After 1 and 2, there could be no price changes on the transaction. So by that, what I mean is the markup on Murabaha, the pricing on Murabaha is fixed. It cannot be changed. So let's say it's a 90-day transaction. First day, bank purchases 100 rupees, sells at 120 rupees. That 120 rupees, whether the customer settles on 90 days or 80 days or 100 days, the total amount to be settled remains fixed from a Sharia perspective. That's the difference of Muraba, right? Any questions? I understand only few people are around, so we'll try to make it fast. So so that's how Murabaha is structured. So we purchase goods, keep a markup, and sell it. And we have installments. You can pay installments. You can pay bullet payment. So that's the underlying transaction. Same as let's say forward transaction, but here we buy first and sell on a deferred basis, right? So in the first point about independent supplier, in this diagram, the customer and supplier cannot be related parties. Customer can't be a parent company of the supplier, or supplier can't be the subsidiary of the customer. These two had to be independent transactions, because otherwise we'll be buying from the same party and selling to the same party in 2 different transactions. One is a spot transaction, one is a deferred transaction, and that is called that is not allowed, because we saw under principles of buy-in, sale and buyback is not allowed from the same customer. So that is not possible. Now, when I said sale and buyback, I said previously when we spoke of ijara, I said sale and lease back is possible. But sale and buyback is not possible. That is the Sharia rule, because leasing back When you sell and lease back, you don't transfer the ownership, right? At least till the end of the contract. But buying and selling from the same party is not considered acceptable on two different terms in Sharia, right? So it has to be two independent parties, the customer and the buyer. Number two, the point number two is appointment of agency. Instead of in the diagram where arrow number 1, where bank buys from the supplier, bank can appoint the customer as an agent to buy on behalf of the bank. So that is beneficial for the bank because it doesn't have to get into the actual transaction of buying. Just by doing a documentation where customer is appointed as agent, you can allow for the murabaha transaction. Breach of promise. Again, going back to the diagram, bank buys, let's say after step number 1, when bank buys from the supplier, before step number 2, where bank sells to the customer, let's say there is a drop in prices, right? Today, bank bought on Friday, bank bought the goods at 100 rupees. And Monday morning, tomorrow, you go to work and you try to sell, the price of pen drops to 80 rupees. Now, customer will say, I don't need the pen any longer from you. So bank can get into a little bit of difficulty. So in order to avoid that, bank gets some kind of a margin or security deposit from the customer to mitigate that loss, where there is a breach of promise, and bank can take into consideration any losses it incurs in transaction like that. It will have some margin so that it is covering itself to some extent. Again, one more rule, there cannot be a rollover in murabaha. Again, going back to the diagram, after you purchase on day 1 at 100 rupees, that is arrow number 1, and sell on day 1 at 120 rupees, what is due to the bank is on point number 3, arrow number 3, is 120 rupees. And at whatever time agreed, let's say after 90 days, right? So on the 90th day, customer can't come and tell the bank, can you please roll over another 90 days? Because he can delay the payment, but bank can't charge anything more on this transaction. What he can do is he can do another transaction for which bank can pay, that is different. But on this transaction, you can't roll over because there is, unless you purchase and you keep a profit and sell, you can't, there is no profit, no rationale in extending a murabaha for the bank because it can't charge anything more, right? So there is no rollover in murabaha. Once the sale is complete, the amount due becomes a debt. And debt from Sharia point of view is you pay what is the par value. Meaning in this case, you pay 120 rupees and that's it. You cannot change that based on the request for rollover, right? So although we are discussing this under individuals, where Islamic banks give murabaha for individuals, that is, let's say to purchase air conditioners, purchase laptops, all white goods. Islamic banks are providing that under similar to personal finance. They are using murabahas for retail purposes. But murabaha is used for business purposes also to finance part of the working capital requirement. So that's the first point I want to clarify. Again, amount of financing is limited by the value of underlying transaction. You cannot give for any amount. If you're purchasing something, based on the value of that only the financing matters. So it can be part finance, it can be full finance, but it cannot go beyond the value of the underlying asset. So Murabahas, the pricing is fixed. Normally, pricing is fixed. As such, it is given for shorter tenor. Pricing is fixed in Murabahas. You can't change. You can benchmark as at today, but you can't revise the prices. All right. So it is generally shorter term. The longer term is called extended Murabaha. Of course, that is fixed pricing again, but bank takes into consideration possible fluctuations and price it accordingly in extended Murabahas. Documentation, standard documentation of personal finance. In addition, Murabaha product documentation is also signed. Collateral can be guarantees, mortgages, it can be given clean, all that is possible. Sometimes people misunderstand to say that if you take a Murabaha for, let's say, a laptop, that has to be the underlying collateral. No, that's not the case. It can be given clean, it can be given on personal guarantees, it can be given, you know, if it is a business financing, you can even take mortgage of property and give facilities. So that is possible. Repayments can be bullet payments or installment, both are possible. Rescheduling is difficult in Murabaha. Normally you cannot reschedule. So it comes, you have to structure another transaction, because after the sale, transaction between the relationship between the bank and the customer is debtor-creditor relationship. As such, the total amount due does not change after the transaction. So difficult to reschedule because not beneficial for the bank. So if Murabaha has to be rescheduled, it has to be structured in some other form to be rescheduled. So we, Islamic financial institution, faced this particular point when it came to moratorium. Initial days of COVID, there was moratorium announced by the central bank. Difficult to reschedule Murabaha transactions because you can't charge anything more. So banks had to adopt certain means to ensure they don't violate the principles of Sharia, but at the same time, whilst ensuring the regulatory requirement is met, which is to give some time for customers to settle, bank has to find a way which is practical to charge something from the customer too. In terms of risks, so credit risk, as I explained, after the sale, debtor-creditor relationship exists. So you have to take whatever security, ensure that your facility is safe. So that is normally whatever the collateral you want, it can be taken. But when it comes to pricing is fixed, so not suitable in a volatile interest rate environment. You can't long-term, if the rates are volatile, you can't get into fixed rate Murabaha for a longer tenor. So that is an important concept, because lots of time when the rates are volatile, you can get into an unfavorable position if you consider Murabaha for longer term. And you cannot charge additional amount if there is a delay. That also, I think last week also we discussed, if there is a delay, you cannot charge. That is the general rule. But the banks are allowed to charge penalty, which is the amount we charge for like a penal interest you can charge, but you can't take into consideration that as your income, you have to give, Islamic banks have to give that in charity. So if that is allowed, penalty is allowed only if a lot of people are trying to take advantage of the system and create some systemic risk for the bank, for the Islamic financial institution, then you can charge a penalty to avoid that delays, right? But you can't earn income and distribute to your depositors. In case of any operational risk, because bank involves Murabaha involves bank buying and selling goods, if there is any operational risk, it is important to be clear in the documentation how it will be handled. For instance, easier way is to appoint the customer as agent, so that customer is responsible for the goods, to handle the goods in reasonable fashion, and to take necessary warehousing or insurance arrangement, so that bank doesn't get exposed to operational risks of purchasing and storing and selling the goods, underlying goods involved. So that needs to be mitigated also through documentation, through appointment of customer as agent. That needs to be mitigated too. Any questions so far?
So under these forward sales and deferred sales, so ownership of goods is held with bank. So do you all sign anything, something related to something similar to trust receipt, because ownership of goods is held with bank?
Yeah. So the Murabaha, the product document has some clauses, but not necessarily. We can take a trust receipt also, but it is not necessary to sign a trust receipt. What we do is, if you appoint the customer as agent and sell, appoint him as agent to buy and sell, upon the sale, the ownership transfers no. So in our diagram, after point 1 and 2, which happens on day 1, there is no risk in Murabaha on the bank related to the goods. So normally that 1 and 2 happens on the day of signing the agreement, meaning dispersing the money. So as long as on that day you have covered your risks, you have to worry less about the actual physical any risks to the commodities after that, especially in Murabaha. But in Salam, your question is very correct. There is risks in with regard to the goods. So that's why I said under Salam, sometimes bank takes a pledge of the goods, so that there is some control, and then even can sign something like a trust receipts or take insurance or have warehousing arrangement, so that that risk is to some extent mitigated. So in practicality, in practical sense, if you are getting into a like a paddy transaction, you find a miller and you have arrangements so that the customer can sell it to the miller, and the transaction can be brought to a close in a quicker manner rather than delaying that process. So that is one way where customers manage. But in Murabaha, that need is minimal, very minimal, because on day 1, that ownership, all the ownership of the customer bank goes to the customer on day 1. Day 1 means on the day where we are dispersing money. So that is relatively, the risk is there, but relatively less. Did I answer the question correct?
Yes, I got it. Thank you.
Right. Okay. So appointment of customer. So that's all on Murabaha. Any other questions? I think only a couple of people are on the on the on the class. So we will look at this. I will you can take a screenshot of this. I'll try to explain this as we go on, and maybe any clarification you all can have. So this is on Murabaha question. This is for business purpose, not for individual purpose, but it can be we can work this out and see if you all are okay with that. Yeah, since 1 or 2 of you all are only there in the class. Shall we work out, or you want to skip and move on? Right. So this particular question, you can take a screenshot or something. Mr. X is a trader, needs to buy following items on reselling purposes, ABC suppliers, electric fans, electric kettles and batteries, number of units and price is given. So normally customer brings an invoice, a pro forma invoice to the bank with this and the amounts involved, right? Amounts involved, and he comes and says, I want so much financing for this pro forma invoice. That's what in practicality it happens in Islamic banks. So he has 500,000 rupees and approaches an Islamic bank for the balance amount. So these are the amounts these are the items he wants to buy for reselling purposes from ABC suppliers. So he has an invoice for this amount. We will calculate the amount shortly. He has 500 approaches Islamic banks for the balance amount. He asserts that he could sell these items and repay the facility in 3 months' time. His usual markup on these items are 50%. What is a Murabaha facility? Explain the steps involved in offering Murabaha facility to Mr. X. If expected return on similar facility is 16% per annum. In case a supplier agrees to offer 1-month credit period to X, how will the above structure change? After the purchasing goods from ABC suppliers on behalf of the bank, before the bank sells to Mr. X, all the batteries were destroyed by fire. Who will bear the loss? I think this is the question just came up. We will discuss that also. If Mr. X is liable to pay capital and markup at the end of the 3 months period, if he hasn't sold all the above goods, if the customer settles a Murabaha capital and markup only at the end of 4th month, could the bank charge any additional income from him? Explain. Right. We will do this question. Can I give you 5 minutes to copy and paste and try, or take a screenshot and try? I think only a couple of people are there. Okay. So I'll try to do this on the screen. I'll stop presenting. You all have taken screenshot. Right, okay. Let me do the question on the board. Mr. X is a trader who needs to buy following items for reselling purposes. Electric fans. He has number and rupees. 200 numbers. 5,500 unit. Electric kettles. 100 and 3,500. Batteries. 1,050. So total value of the invoice 110. 1.1 million 35. $50,000. So altogether, the performer invoice is worth 1.5 million rupees. All right. That's what first I worked out. What did I work out? How much money he needs in order to work out that. First, we have to look at the invoice. If he's buying and selling, if the bank is to buy and sell, how much it needs to buy. All right. Now he has 500,000 rupees in his hand. So bank needs, what is the amount he requires from the bank? 1 million rupees. Right? How did I arrive at it? Based on what the question says. All right. He asserts that he could sell these items and repay the facility in 3 months' time. 3 months' time, he can. His usual markup on these items are 50 rupees. Now that particular statement is not required for us, right? Why is that? Bank in a Murabaha, there is a supplier, bank buys from the supplier and sells it to our customer, right? So bank buys, let's say 100 rupees and sells at 120 rupees. Buys on spot, sells on credit. 3 months, within 3 months payment, right? Now this customer, how much he sells to these goods, whether he sells on profits or losses or high profits, 150 or 200, all that is immaterial to the bank. That is the case in a sale transaction. In a partnership transaction, his profits will become shared by the bank. Because nature of partnership transaction is it shares profits and losses of the partnership. Nature of sale transaction is that it is absolute transaction. You buy something and sell, end of story. Beyond that, what that was sold at, you can't ask, right? That is in practice. I buy this pen for 100 rupees, I sell it to somebody else for 120 rupees. That man sold, let's say, to another person at 500 rupees. Now I can go and say, share some profits from your transaction, because sale is absolute transaction. Beyond that, it doesn't go. So, how much markup he keeps beyond this is not required for us, right? So that's what I want to explain first. His usual markup is 50%. We'll ignore that. What is a Murabaha facility? Murabaha facility is a deferred sale offered by Islamic banks. It's a facility offered by Islamic banks based on the concept of deferred sale. Deferred sale where bank purchases goods on spot basis and sells to the customer on deferred basis, usually with a markup and at a credit period to settle that. Something like that. A diagram like what I just drew, something like that will be helpful in answering that question. Number 2, explain the steps involved in offering Murabaha facility to Mr. X if expected return on similar facility is 16% per annum. 16% per annum. 1 million rupees. Now I have worked out 3 things. The amount, the time period, and the return required, right? Now, every product we discussed, I will first try to work out this while I'm doing the transaction, because the pricing on any of these products will depend on the amount given, the tenor, and the rate. But it is structured in different ways in different products. That's why we are working out this, and we are arriving at the actual transaction, right? So now we have a problem. What is the problem? You can't say buy for 1 million and sell for 1 million, right? Now you have to say buy so many fans, buy so many kettles, and buy so many batteries to arrive at your amount. Now that's why this particular the list of goods is given to create that check that understanding, right? You can't just say buy for 1 million because he wants a facility for 1 million, buy for 1 million and sell for 1.1 million or something like that. So first, what I will do is, first we will see where we can arrive at 1 million. Now this answer, different people can get different answers, because for 1 million, you can buy different things here. The combination can be anything. So I thought if this was 5,000 rupees, you could have arrived at something. 170. Shall we check 170? $170 in 5,000. Okay, I will buy 170 fans at 5,500, which will be 935,000. So 65,000 divided by 3,500. So first, we are going to give 1 million rupees. Of that, if I give 5,500, if I buy 5,500 fans, no, sorry, if I buy 170 fans, at 5,500 will be 935,000. If I buy 180, which will that be? So what I'm trying to do is, I'm trying to identify goods to purchase for this amount. That's what I'm trying to do. You can do it in any way you like, as long as it adds to 100,000 rupees, it's okay. Sorry, 1 million rupees. So 180 into 5,500. Yes, I like that. 90,000. 180 fans at 5,500 will be 990,000. So we need to give for 1 million rupees. I have given 90,000 rupees. Balance 10,000 rupees. I will buy at 50 rupees. $200 batteries. So altogether, we can give 1 million rupees. That's the first step. So you have to say in the transaction what you are purchasing. So purchase, first step is purchase 180 bat fans at 550 and 200 batteries 200 at 50 rupees, totaling 1 million rupees. That's the first step, right? The question is, explain the steps involved in offering Murabaha facility if the expected return is similar facility is 16%. So then we had to agree on the sale. You have to keep this 16% markup on this. So that total amount comes to 1 million, whatever that is total is. So let's do this. 4%. So 4% on 1 million is 1, 2, 3,000, 10,000, 40,000. So this into this is 40,000. Is that right? 4%. 1% is 10,000. 4% is 40,000. So I sell the fans at 4% more. Will be 180 into 4% more is 550 into 1.04. 572 batteries. This is fan batteries. 200 into 52. If you multiply 180 into 572 plus 102, 180 into 572. I'm sorry, I made a mistake. It should be 550, 5,500. 5,500 into 80, 180. So purchase at 5,500. So sale at 5,720. Is that clear? 1,029,600. And 200 at 52, 410. 0, 0, 0, 0, 4, which is equal to 1 million plus this 40. So purchase fans at 180 fans at 5,500, 200 batteries at 50 rupees for the total of 1 million rupees. Sell them on credit with 3 months tenor. 180 fans at 5,720, totaling 1,029,600, and batteries at 52 rupees, 200 batteries at 10,400, together 1,040,000. This 40,000 comes from 1 million into divided by 3 months, multiplied by 3 months divided by 12 months into 16% per annum. How I arrived at these prices is I used the 4%, 3 divided by 12 into 16 to multiply this 5,500 into 4%, 50 into 4%. I arrived at individual prices. So answer is to buy at this price, sell at this price with a 3-month tenor. Right? That is the answer to question number B. In case supplier agrees to offer 1-month period to Mr. X, how will the above structure change? Question number C. In case supplier agrees to offer 1-month credit period. So if 1-month credit period comes, what it means is on day 1, the bank does not have to pay. So if the customer can sell in 3 months, instead of 3, this becomes 2. So instead of markup of 16%, the markup for 3 months is a markup for only 2 months. So the markup reduces throughout. And the payment, bank will not pay now, bank will pay in 1 month's time. So bank will be out of cash out for only 2 months, and it will charge for the transaction only for 2 months. That's the answer to question number C. After purchasing goods from ABC, from suppliers on behalf of the bank, before the bank sells to Mr. X, all the batteries were destroyed by fire. Who will bear the loss? The answer is bank. If bank owns the batteries and before it sells to the batteries to the X, if it destroyed by fire, the ownership of the goods are with the bank, so it should bear the loss. That's why it makes sense to mitigate that risk. The moment it buys, it will immediately sell. On day 1, immediately it will sell, so that that risk is mitigated. Is Mr. X liable to pay capital and markup end of the 3 months if he hasn't sold the above goods? Answer is yes. Bank does not look at whether he has sold the goods or not. Bank is buying and selling to him, and that sale transaction is complete. It doesn't look at transaction beyond that. If the customer settles Murabaha capital markup only end of 3 months, could the bank charge any additional income from him? In general, bank cannot earn from any delay in Murabaha. However, in order to avoid systemic risk, bank can charge a penalty, and that could be given on charity. So those are the broad answers to the question. Share the screen. Right. So with that, I think we have come to the conclusion. There is a slide on diminishing musharaka, which is a type of musharaka which we discussed, where there are 2 parties, but in this case we use this to give housing facilities. So we won't go into details. So it's let's say I want to buy a 10 purchase house. I have 1 million rupees. I need 9 million rupees. Bank gives the 9 billion rupees to the customer, but you treat the property in which the house is established as a musharaka property, so that every monthly, if I pay 1 million rupees to buy bank share, I will pay in 9 months, I will buy bank share of my house. If 10 million and monthly I pay 1 million, I will buy the bank share of house. During my occupation, during that 10 months, for ownership of the bank, I have to pay a rental for bank's ownership of the property. That's how it's structured. So it's the main meaning you have to understand is that housing is done on diminishing musharaka purposes. But there is this concept of buying property every installment you make is not shared by any legal framework, including in Muslim countries, because that's difficult proposition, because you can't write a deed every time you pay an installment. So what happens is, normally in practice, the bank, the customer's deed is written in customer's name, and bank takes a mortgage. In Sri Lanka, bank takes a mortgage over the property, and at the end of paying, once customer finishes paying the loan, paying the installments, the bank releases the mortgage. So although in principle, Sharia wise, customer owns part of the house, bank does, that is not reflected 100% in the documentation. The deed is written in customer's name, so technically he is the owner, but bank takes the mortgage to cover its ownership, right? So this is one area where the principle of Islamic finance is not reflected in the documentation, but that is for a valid reason, because it is what is documented is the owner is the customer. That is what is documented in the deed, because if you take the deed, it's customer. But because underlying transaction is facility by the bank, bank's interests are covered by the mortgage in this case, right? Again, the charges can be based on fixed benchmark or fixed amount or whatever. Normally it's benchmarked, and it is given for financing housing construction and all that by the bank. So let me summarize within a minute. What we have done so far is that last session and this session, we have looked at how Islamic banks provide facilities. What we are saying is these facilities are invariably linked to the underlying transaction in whatever the underlying transaction. So the Islamic banks create the financial intermediary relationship based on these principles without giving loan and charging interest. They use other contracts like the partnership contract, like the sale contract, like the lease contract or similar contracts to create this arrangement of either accepting deposits or lending money to the customers. We didn't talk so much about deposits because we are focusing on lending products from a credit perspective. So we talked about few broad products that bank will use when it comes to lending. We also looked at the features of them. We looked at the documentation or key nuts and bolts involved. We looked at the process. We looked at the risks. We also looked at examples, how in reality how it will work and how these products are different from conventional banking products. So for the exam, what we will do is, since only a couple of you all are there, let me tell you this. For exam purposes, what we will do is we will of the questions we have done three questions, I think, with the last question. Of this, we will take one of the questions and put for exams, not exactly the same questions, similar questions. What I mean by similar is you may be asked introductory question saying, what do you understand by Islamic banking or something like that, or what do you understand by Murabaha, something like that. Then actual calculations involved. Then you will have a final calculation, a final question asking for differences, similarities between conventional banking facility and this particular product, either Murabaha or Musharaka or ijara or something like that. There may be a question on what is the difference between musharaka and murabaha, something like that. Also can be there. In case you see a big chunk of question, you choose to do this and you see a big chunk of question which we haven't done here. Let's say there is a part C which talks about big changes. It has happened once or twice. In principle, you don't have to worry about that big change. For instance, one year I gave a question where we gave little more details of how in a Salam question, how the farmer wants to utilize. 10% he wants pre-harvest, during harvest, post-harvest, something we had given a breakup and different costs involved. We talked about it in the lecture also. But when I incorporate that into question, it looked very difficult. But actually, it's simple. So you have to just calculate based on the percentage. You have to calculate the volume, meaning let's say 1,000 kilograms. You calculate 30% of 1,000 kilograms first, 40% of 1,000 kilograms next, and balance 30% of 1,000 kilograms third. So it's just calculation by multiplication by percentage. But if you understand the principle, because what we said is we can't pay the full price. So, if you want to manage disbursements in chunks, in proportions, you have to use something like that. So even if there is a big change, you don't have to worry about it. You just write what you understand as principle. You should be okay most of the time. So practicing the questions, of course, don't ask me which of the question will come. One of the 3 questions we did can come for the exam, provided that you want to do this. So practice all 3, read through the entire slides, be familiar. So since only a couple of you all are remaining, I'm assuming you all want to do the questions. So that's why I'm telling you this. So if you are familiar with these questions, one of these questions with some modification will come for the exam. Don't expect the same question. I won't put like that. There will be some modification, but something which, if you understand this lecture and the previous lecture, you should be able to handle without much problem, right? So if you have any further question, I'll be more than happy to answer. Thank you very much for remaining with me. I think most of the people have left out, so I should thank 2 or 3 people who are hanging around. Thank you very much. Any questions you all have, I'll be happy to answer. Otherwise, we can conclude.